Welcome to the Deep Dive. This is where we sift through the sources, pull out those crucial bits of knowledge, and help you get properly informed, without all the noise. Today, we're plunging into something fundamental, something that happens pretty much every time you buy on credit. Just think about it, that new phone maybe, or a service you used, and you get the bill later. How does that business actually keep track of the money you owe them? What's going on in their accounts?
It is a really fascinating area of finance, often flies under the radar, but it's incredibly important. So this deep dive, it's all about trade receivables, what they are, how they happen, and crucially, why they're so vital for a business's health. They impact everything, really cash flow, profits.
Right. So our mission today isn't just the accounting side, the debits and credits. We want you to really grasp the bigger picture. These promises to pay, they have some surprising effects on a company's profits, their day-to-day operations, even how investors see them. We're going to trace the whole journey from the moment a credit sale is agreed right through to getting the cash, what happens if the cash doesn't come, and, well, the clever ways businesses account for it all.
Yeah, it's absolutely essential if you want to understand a company's true financial position. And it tells you a lot about how efficiently they run things.
Okay, let's kick things off then. The basics first.
Yeah.
What exactly are these trade receivables?
Okay, simplest terms. Trade receivables are the amounts that customers owe a business, owed for goods or services that have already been delivered or provided, but on credit. So you've done your part, delivered the goods, now they owe you the money. It's basically like an official IOU in the business world.
Got it. So let's say Ben sells stuff on credit to Candor. Candor gets the goods. Ben sends an invoice, pay me this much in 30 days. So from that point, Ben has a trade receivable. That promise from Candor.
Exactly that, yeah. And the total amount of trade receivables a business has at any one time, well, that basically represents all the sales they've made that haven't been paid for yet. And that total figure, it's not fixed, it's constantly changing.
Right, constantly moving. So apart from just making more sales, what else makes that total number go up? Maybe things that aren't so obvious.
Well, obviously, the more credit sales you make and the higher their value, the more receivables you'll have. That's straightforward. But also think about the credit period. If you give customers longer to pay, say 60 days instead of 30, your receivables balance will naturally be higher on average. And, this is a big one, how efficient is the business at actually billing and collecting? If they're slow or sloppy, that receivables number will definitely creep up.
Okay. So that pile of IOUs can really balloon if a company isn't careful. And like you said, this isn't just bean counting. For many businesses, this expected cash is, well, it's their lifeblood, isn't it? It's literally what funds the next payroll, the next order of supplies. So understanding how these promises get recorded seems super important.
Absolutely. Let's maybe walk through an example, see how that initial promise actually hits the books.
Yeah, perfect. Let's make it concrete. Imagine Ingrid. She supplies materials. She gets an order from Manfredi, let's say March 16th, 2000XR. We'll keep it simple, no sales tax for now. The order's for $6,450, payment due in 30 days. Sale and delivery happen the next day, March 17th. Manfredi checks the materials, signs the delivery note, accepts the invoice. Ingrid's definitely made the sale.
Okay. So the moment Ingrid makes that credit sale, her internal records need to show that Manfredi now owes her $6,450. You can think of it like she keeps a specific log for each customer, a subsidiary ledger, technically. So she can look up Manfredi anytime and see exactly what he owes.
Right, keeps track of individual customers. And in the main accounting system, the general ledger.
At the same time, yeah. In her main system, Ingrid increases an account called trade receivables and also increases her revenue account, both by $6,450. That's where the official financial picture gets updated.
Okay, this idea that it's an asset right away, even before the cash comes in, that can feel a bit weird. Why is it an asset if the money isn't actually there yet?
That's a really good question, and it comes down to the formal definition of an asset. The IASB, that's the International Accounting Standards Board, they set the global rules. They define an asset as a present economic resource controlled by the entity as a result of past events.
Mm-hmm.
And the economic resource is defined as a right that has the potential to produce economic benefits.
Okay, slow down. Let's apply that to Ingrid.
Sure. So Ingrid's business is the entity, the past event. That was the sale and delivery of the materials to Manfredi. And the potential to produce economic benefits. Well, that's simply the cash he expects to get from Manfredi when he pays. She has a legal right to that future cash. And that right is the resource, has value.
Got it. So it's not just a placeholder, it actually meets the definition because of that right to future cash.
Yeah.
Okay. And how does recording this asset before the cash affect Ingrid's overall financial health, like on her balance sheet?
Well, the impact is quite direct. Her inventory goes down,
Yep.
right, by the cost of the goods she sold because they're gone. But her trade receivables, that right to collect cash, goes up by the selling price. So notice this, her total assets actually increase. By how much? By the profit she made on that sale. And because assets went up without liabilities going up by the same amount, her equity, the owner's stake, also increases.
This is the part I always find slightly counterintuitive. Companies reporting profit before the money is actually in the bank. What's the logic there? Why do accountants do it that way?
It's a fundamental principle called revenue recognition. The core idea, especially under the current global standard IFRS 15, is that revenue is recognized when you transfer the promised goods or services to the customer. It's about when the customer gains control. Once Ingrid delivered those materials and Manfredi checked and accepted them, she fulfilled her part of the deal. She's earned that revenue at that point. It doesn't matter when the cash actually shows up.
So the moment of sale, the transfer of control, that's the trigger, not the payment itself.
Exactly. For Ingrid's sale, that happened on March 17th, 20X9. When Manfredi signed that delivery note, she fulfilled her obligation. So she recognized $6,450 of revenue on that date. And, this principle, recognizing revenue before cash, it's powerful, but also tricky. Shows the economic reality of the sale immediately, but it means reported profit doesn't always equal cash in the bank. Big difference sometimes.
That is a really important distinction. Quick question, though. You mentioned no sales tax in the example. What if there was sales tax? How does that fit in?
Good point. If Ingrid charged sales tax, say 10%, the total invoice Manfredi owes would be higher, right? $6,450 plus tax. But, and this is key, Ingrid only recognizes the $6,450 as her revenue. Why? Because that sales tax isn't hers to keep. She's just collecting it for the government. So it increases the receivable, the total amount owed, but not the revenue line on her income statement.
Okay, that makes sense. She's just a collection agent for the tax part. So moving along the journey, what happens when the payment does arrive? Let's say Manfredi pays up, nice and prompt, within the 30 days, say April 16th. What happens in Ingrid's books then? Okay,
ideal scenario. Payment comes in. So Ingrid's bank account goes up debit bank, and her trade receivables account goes down by the same amount, credit trade receivables. Manfredi's individual customer account is also updated, credited, showing his balance is now zero.
So for Ingrid's business, the asset trade receivables basically swaps places with the asset cash at bank. One goes down, the other goes up by the same amount. Transaction complete.
That's the smooth path, yes. But life isn't always smooth. Businesses often need to nudge customers to pay quickly.
Right. Discounts. You see it all the time, don't you? 2% off if you pay within 10 days or something like that. Settlement discounts, prompt payment discounts.
Exactly. They're offered purely to get the cash in faster. But from an accounting perspective, this introduces uncertainty. It's called variable consideration under IFRS 15. Because now, Ingrid isn't sure exactly how much cash she'll ultimately receive for that sale. Will they take the discount or not? The accounting actually depends on what she expects the customer to do.
Okay, let's stick with Ingrid and Manfredi. Imagine Ingrid offered a 2% discount if Manfredi paid within 15 days instead of the full 30. And let's say Ingrid genuinely expects Manfredi to take that discount. He usually does.
Okay, if she expects him to take it, she could record the revenue initially net of the discount. So she wouldn't record $6,450. She'd record $6,450 minus 2%, which is $6,321. That's the amount she actually expects to be entitled to. Now, if Manfredi doesn't pay within the 15 days and misses the discount window...
so he ends up paying the full $6,450 later.
Right. Then Ingrid would recognize the extra $129 as revenue at that later point.
Yeah.
When the discount period expires and he hasn't taken it.
Okay, and the flip side. What if Ingrid doesn't expect Manfredi to take the discount? Maybe he never pays early.
In that case, she'd initially record the full revenue, $6,450, because that's what she expects to get. But if Manfredi surprises her and does pay within the 15 days, taking the discount, then Ingrid has to adjust. She'd reduce both the revenue and the receivables recorded by that $129 discount amount, effectively bringing the recognized revenue down to $6,321 after the fact.
Interesting. So either way, the final revenue number reflects the actual cash received, but when it's recognized, depends on that initial expectation. It really shows how pricing strategy and just knowing your customers' habits feeds directly into the financial reporting and forecasting, doesn't it?
It absolutely does. It's a constant balancing act between encouraging early payment for cash flow and maximizing the revenue from each sale.
Okay, but now, the not so nice part, the grim reality. What happens when customers just don't pay? Manfredi misses the deadline, maybe by a long way.
Yeah, this is where things get tough. Ingrid needs solid procedures for monitoring overdue accounts, chasing payments, reminders, calls. Non-payment is a serious risk. It can really hurt a business.
And eventually there might come a point where Ingrid has to face facts. Maybe Manfredi's company goes bankrupt, or he just vanishes. She has to accept that the $6,450 is gone. It's not coming back. At that point, the receivable isn't really an asset anymore, is it? Because that potential for future economic benefit, it's disappeared.
Exactly. It's lost its asset quality. So let's say, deep breath, on December 28th, 2000X, Ingrid decides this debt is irrecoverable. She has to write it off. And her accounting record, she'll record an expense, usually called irrecoverable debts expense or sometimes bad debts expense, that gets debited. And she reduces her trade receivables credits that account. So the asset effectively transforms into an expense on her income statement, a loss.
And the impact on profit here, it's bigger than just the lost $6,450, isn't it? Let's say Ingrid makes a 30% gross profit on her sales. Writing off that $6,450 debt means she lost the profit she would have made. To just get back to breaking even on that one failed transaction she needs to make. Hang on. $6,450 is 70% of the selling price if the cost is 70%. No, wait. The $6,450 is the selling price. If her profit margin is 30%, her profit was $1,935. The cost was $4,550. Okay, so she lost the $1,935 profit and the $4,550 cost. But to replace that lost profit of $1,950 in sales, just to cover the profit lost on the bad debt, is that right?
Well, thinking about it differently helps. The $6,450 write-off hits the expense line directly. If her gross margin is 30%, she needs to generate enough gross profit from other sales to cover that $6,450 loss. So $6,450 divided by her 30% gross profit margin means she needs, an extra $21,500 in sales just to generate the $6,450 gross profit needed to offset the bad debt write-off.
Wow. Okay, $21,500 in extra sales just to stand still because of that one default. That is huge. It really hammers home how critical collecting that cash is. A sale doesn't mean much if it turns into a bad debt.
Precisely. It underscores why managing credit risk is so vital, which leads us naturally to, planning for this, the allowance for irrecoverable debts.
Right, the allowance, sometimes called allowance for receivables or allowance for doubtful accounts. So this is where, even if you're not sure a specific debt is bad, you make a general provision, especially at year-end.
Yes, exactly. It's about prudence. And it ties into another accounting idea, the matching principle. The idea is you should match expenses with the revenues they help generate in the same accounting period. So if you made sales in 20Xn, the potential cost of some of those sales eventually going bad should also be recognized as an expense in 20Xn. Even if you don't find out which specific customer won't pay until maybe 20X1. You make an estimate at the end of 20Xn.
So it's like an educated guess about future losses arising from this year's sales.
That's a good way to put it. So think about Ingrid at the end of 20X6. She already wrote off Manfredi's $6,450 and maybe some others during the year. Let's say total write-offs were $196,201. Then she looks at her remaining receivables. Based on past experience, aging reports, economic conditions, she estimates that, say, an additional $16,254 might go bad in the future, relating to sales made in 2000X. The total irrecoverable debts expense she'd report for 2000X would be the actual write-offs, $196,201, plus this new estimated allowance, $16,254. So $212,455 in this case.
Okay, so that's the expense hitting the profit and loss. How does the allowance part show up on the balance sheet, the statement of financial position?
Good question. It's shown as a reduction from the total trade receivables. So you'd see gross trade receivables less the allowance for irrecoverable debts equals net trade receivables. It presents a more realistic picture of the cash the company actually expects to collect.
But wait, what if Ingrid already had an allowance estimated at the end of the previous year, say 20X9? She can't just add the new allowance on top, right? That would overstate the expense over time.
Absolutely right. You need to account for the change. If she had, say, a $12,028 allowance at the end of 20X9, that related to potential bad debts from 20X9 sales. The actual expense charged to profit and loss in 2000X becomes a bit more nuanced. It's essentially the debts actually written off during $196,201 minus the allowance brought forward from last year, $12,028, because I was anticipating some of this year's write-offs, plus the new allowance needed at the end of 2000X is $16,254. So in that case, the charge for 2000X would be $196,228 plus $16,254 plus $16,254 fast down.
Okay, let me try and simplify that. The hit to profit for the year is basically what you actually lost this year, write-offs, plus or minus the change in your estimated future losses, the increase or decrease in the allowance balance.
That's a great way to think about it, yes. It reflects the cost of bad debts incurred during the year, including adjusting the estimate for future losses. The key thing for you, the listener, is that this whole allowance process is about transparency and realism. It stops companies from looking healthier than they are by showing inflated receivable figures. It's prudent accounting.
Okay, so given how painful bad debts are, how do businesses try to stop them happening in the first place? This is where credit control comes in, right? And it's not just chasing overdue money.
Not at all. Good credit control starts way, way earlier.
Yeah.
It's fundamentally about prevention.
So what are the foundations?
Well, first, arguably most important, who do you even give credit to? That initial screening is critical. It's a real balancing act. You don't want to sell to someone who's likely to default. That $21,500 extra sales example shows why. But be too strict, and you might turn away perfectly good customers and lose valuable business. So businesses need processes. Credit checks, maybe asking for trade references, looking at payment histories. You have to assess the risk before you agree to the sale.
Okay, assess the customer. Then what?
Then you need clear terms of credit. These need to be agreed up front. How much credit are you offering the credit limit? How long do they have to pay the credit period? Are there discounts for paying early? Is there interest charged if they pay late? And these terms might not be the same for everyone. A long-standing, reliable customer might get better terms than a brand new one.
Makes sense. Risk-based terms. And the third pillar.
That's the administration of billing and collection. Basically, the paperwork and processes. You need to send invoices out quickly and accurately, make sure they match the purchase order, delivery notes, everything. Any errors just cause delays. And understanding customer payment cycles helps. Send statements regularly, gentle reminders before the due date, firmer ones after. And when accounts are overdue, the collection process needs to be systematic, fair, reasonable, legal. Not just hoping automated emails do the job. It needs active management.
So it's really a whole system, from checking customers out initially, setting clear rules, and then having efficient processes for billing and follow-up.
It really is. It's often the unsung hero or villain in a company's financial story. Get it right, you thrive. Get it wrong, well.
Now, sometimes, just sometimes, there's a twist, an unexpected recovery.
Ah, yes, the good news story. So imagine Ingrid. She wrote off Manfredi's $6,450 debt back in December 20XX. Painful. Then, surprise. In 20X1, a check arrives from Manfredi for the full amount, maybe with an apology note.
Okay, so how does she account for that? The debt was already removed from receivables, wasn't it?
Correct. It's not sitting in receivables anymore. So when the cash comes in, Ingrid simply increases her bank account, debit bank. And the other side of the entry, she credits the irrecoverable debts expense account. Effectively, it reduces the bad debt expense being reported in 20X1. It's like getting a refund on a previous cost. Some companies might use a separate irrecoverable debts recovered account, which is also fine. It achieves the same result.
And what should Ingrid maybe think about, bigger picture, when this happens?
Well, it's definitely a moment to review. Was she maybe too quick to write off that debt back in 20X? Should she adjust her criteria or procedures for deciding when a debt is truly irrecoverable? It's a learning opportunity. But one crucial point, she does not go back and adjust the revenue from 20X. That revenue was correctly recognized when the sale happened. This 20X1 event is purely the recovery of an amount previously expensed, not a new sale.
Right, revenue stays put. It's about the expense reversal. Okay, wow, we have covered a lot of ground today. From that initial credit sale, recognizing the revenue, dealing with discounts, the pain of write-offs, estimating allowances, controlling credit, and even those surprise recoveries.
Yeah, it's quite the life cycle. And the key thing for you to take away really is that trade receivables aren't just, boring numbers on a balance sheet. They represent promises. They embody risk. And they tell you a huge amount about how efficiently a company manages its operations and its cash. Understanding them gives you real insight.
Absolutely. So maybe the next time you buy something on credit or you see that sign offering 5% off for early payment, just take a second. Think about that whole complex dance happening behind the scenes, the accounting, the risk assessment, the strategy, all focused on making sure those crucial promises to pay are ultimately kept.